Hey, welcome to the Money Multiplier Infinite Banking full presentation. This is an introduction to the infinite banking concept, otherwise known as becoming your own banker. And what I'm going to do tonight is lead you through from the beginning to the end of what the infinite banking process is, how you can start applying it in your life, and what it can do for you and your family's financial future. So this is what we call BYOB, or as you can see on my hat, becoming your own banker. So my name's Stephen Nagy, and that's all my information on the screen. I'll be sharing this with you as we get going. But what we're going to be talking about tonight, on top of the money multiplier and the infinite banking concept, is a very important subject, and that's money and opportunity. So money and opportunity is one of those things in the world that we don't always talk about. And what I mean by that is money historically has always been kind of a mystery. Like, growing up, typically, like, you don't ask your parents, or your parents don't talk about with their friends, how much money they make or how they invest, and different things like that. When it comes to financial subjects, it was always kind of one of those taboo subjects to talk about. So money's not a mystery, though. And once you really understand money, it's no longer something that you have to have other people manage for you, or that you have to be scared of, or that it's not a complex subject. There's very simple strategies that you can follow to take back control of your money and start implementing these things in your everyday lives. And if you do this, you'll be in a much better position next year, the following year, 5 years, 10 years from now than you are today, by following proven strategies that have been used for literally hundreds of years. And that's what I'm sharing with you here tonight. And I teach a lot of different financial strategies and topics. I talk a lot about real estate investing and the opportunity in the markets, what's going on right now with inflation and interest rates, and what the Fed is doing and different policy. But we talk about a lot of that on our other webinars. So every Wednesday, Chris and I do 3 different webinars that you're going to definitely want to join. So if you don't have the links for those, reach out to me, let me know. I'll send you the links for them, or just go over to Chris's YouTube channel. Which, by the way, if you want to watch the rest of that video that I was playing when we just got started, you can watch that on the YouTube channel. So it's YouTube at the Chris Noggle. Subscribe while you're over there. And we live stream a lot of our shows on that channel as well, so you can catch them. But every Wednesday at 9:30 a.m. Eastern, we do a What the F Happened market update. What's going on in the week in the news, what kind of policy is driving your money, what are the markets doing, what's going on, so you're aware of what's happening. And then every Wednesday at 1 p.m. Eastern, we do Wealth Webinar Wednesdays, where we talk about all kinds of financial topics and strategies. For instance, if you're looking to take back control of your retirement funds, so old 401ks, IRAs, Roth accounts, things like that, we talk a lot about self-directing and how you can do that in different alternative assets that you can invest in, things like real estate and passive money lending and notes and crypto. So we talk a lot about that on our wealth webinar, as well as our training events that we do, our Money School Essential training events, which we do have one coming up in a week and a half from now at the end of July. It is sold out. The live show is sold out, but you can still get a virtual ticket. So if you want to join us virtually, you can definitely do that. It's going to be 2 full days, and it's a really, really powerful financial 2-day training class. But again, today is going to be all about the infinite banking concept and how you can become your own banker. So with that being said, a couple people I need to introduce you to if you don't know them already. The first one is Brent Kessler. Brent is the founder and CEO of Money Multiplier. Brent is my go-to, and basically between him and Chris Noggle, they're the ones who introduced me to the infinite banking concept a little over, about 3 years ago now. So Brent Kessler is the man, and if you don't know him yet, you definitely will get to know him as you start this financial journey with us. And then if you're here right now, odds are Chris Noggle. Chris Noggle's my mentor when it comes to this, as well as several other financial strategies. He's my business partner, and he is, as we like to say, my partner in crime on everything that we do, even though you probably shouldn't use the word crime when it comes to finance and money. But those of you that know us know that you know that we like to have a lot of fun and we have a good time. And That quote on the screen right there is one of the reasons when I first met Chris that I absolutely loved him. It's never about your actual resources. It's about how resourceful you can be. And that right there is everything. And I want you to think about that as we go here tonight. One other quote is very, very important. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So think about that as we go here this evening as well and what that means, because there's a lot of information out there. There's a lot of noise out there, people telling you what to do, whether it's on the news, on CNBC, whether it's on the internet, on Facebook, whether it's your financial advisor, whether it's friends and family. There's a lot of people that think they know what they're doing. Unfortunately, most people think they know what they're doing, but they don't. And they've just because they've been doing something their entire lives doesn't mean it's necessarily the best way to do it. Would you guys agree with me on that one? And we see this time and time and time again, where I introduce them to something new, a new strategy, something like becoming your own bank, and immediately they shut down. No, 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 no. There's no way that that works. There's no way that can be. I mean, that's what Chris Nagel himself's first reaction was. There's no way you can do this. I've been selling financial service products for the last 16 years, and there's no way you can do this. What you guys are talking about. And Chris is one of the biggest proponents of the infinite banking concept today, because he had an open mind and he realized that other people can teach him things. So I want you guys to do that as well. That last quote was right here. It's never about your actual resources. It's about how resourceful you can be. And Chris, what that means is it doesn't matter where you're starting right now. What we teach will work for anybody. It can work for somebody that's living paycheck to paycheck, looking to get themselves in a better financial position, somebody that's $500,000 in debt, or somebody that's got several $1,000,000 in the bank. It's not about your resources you have right now. It's about how resourceful you can be. And we'll talk about that as we go here tonight. And the reason why I know that this quote right here is just so true is because in this country right now, if we look at success, financial success, and a way to determine financial success, because there's an argument to be made, right, that everybody in America is financially successful. What do I mean by that? Well, almost, unless you're living under a bridge, which a lot of times people choose that, or they've just ran into, temporary hard times. But for the majority of Americans, they have a roof over their heads. They probably have air conditioning, probably have a cell phone, probably have a television. If you compare that to 100 years ago, that's a much different looking situation, 200 years ago, 300 years ago, etc. So why in this country, if we look at success rates, are less than 5% of people are actually successful? And a way that we can actually measure that in terms of financial success is at retirement. So what the Social Security Administration tells us, that if you take 100 people at retirement age, only 5 out of 100 of those people are going to be able to retire in a lifestyle that financially makes sense to them. Meaning 95 out of 100 people, 95% of Americans right now are having to either push back retirement, get another job in retirement, or drastically change the way that their retirement looks, meaning have a less than desirable lifestyle during retirement. So you've worked your whole life listening to what other people have told you to do. You get to retirement and all of a sudden you're not one of the 5%. Why is that? And there's a number of reasons why that is, but I wanted to hit a couple of them right now with you guys, because I've been doing this now for 14 years and I've been in the financial education space for 16 years now. And over that time, I've worked with thousands of clients. I've worked with thousands of people all across the United States of America with all different types of lifestyles, all different types of walks of life. But at the end of the day, it boils down to a handful of reasons why more people are not more successful. So the top 3 right here that you see: taxes, inflation, and volatility. These are things that I can teach you right now tonight how to start solving and put yourself on a different financial projection moving forward. The bottom 3 reasons you see on here are things that you're going to have to do yourself. So I can teach you, but then it's going to take you to take action and implement. Okay. So you can learn everything in the world, but unless you implement it and get over your own reasons for not doing something in the first place, you're never going to accomplish it. And think about this for a second. If books and tapes, if education alone created success, librarians would be millionaires, right? Think about that for a second. It's kind of a silly little joke, but it's some truth in that, right? They're surrounded by books and everything you could ever want to know in the world. And today with the internet, you can literally go online and learn everything you want. But then it takes you to actually either have somebody help you do it or guide you along the way or get you over that fear and actually take action to make it happen. So we're going to talk about this stuff here tonight. And I'm going to show you how to overcome all of this. And then it's going to be up to you to overcome it, because let's just talk about it for just a second. Think about taxes. What do taxes do every single day? Well, we all pay taxes. It's one of those things in life you can't avoid no matter what, but there's strategies that can allow you to pay less in taxes to keep more of your hard-earned money. I think Warren Buffett is the one who said it. He said, there's something going on when I pay less taxes than my secretary, but it's all legal. Inflation is simple. Inflation, it's been all over the news lately. We don't always talk about inflation because it's been pretty under control for most of my life, really. But inflation's right now at record highs in my lifetime. It's 41-year highs, higher inflation right now. We're up at like 9% according to the government, more like double digit, 20, 25, 30% inflation in the real world. So what is inflation? Inflation simply means what I'm able to purchase today, I'm going to be able to purchase less of it tomorrow. It's basically what your dollar is worth now. That same dollar is going to be worth less each year and year and year and year moving forward. So it's the depletion of what that dollar, the purchasing power of that dollar. So if I take a bottle of water, I don't have a bottle of water with me, but if I had a bottle of water, that bottle of water might cost me $1 this year. Well, that same bottle of water next year might cost me $1.10 and then $1.20. Think about what gas used to cost. Think about what the grocery store with what's food used to cost. That's inflation. And then volatility. Volatility is the up and down of markets, of investments, of stocks. Volatility is an interesting word because you're always going to hear things like this: put your money in stocks and it's always over time going to go up, even if we see some downturns and upturns. But then we look at like the drawdown effect, where for every 100%, for every 50% I lose, I got to earn 100% back. For every 10% I lose, I got to earn 15% back. So there's this drawdown effect. And then you start looking at like average versus actual rates of return. And there's always these little tricks in the financial industry to try and make volatility not look as bad as it is. But volatility is a killer. I mean, if you're approaching retirement right now, let's say you're retiring this year or in the next 2, 3, 4, 5 years. Well, you don't have time for that market to come down and then wait for it to get back up. You're going to need that money for retirement when you need it. So if we're in a volatile environment right now and we're trusting our money in this volatile market and it's down when we need it, then you're screwed, right? And that's what happens to so many people. I mean, go back to this 5%. It happens time and time and time again, year after year after year, market cycle after market cycle after market cycle, but people do not make the changes that they need to resolve that. So this is all stuff we're going to talk about and start solving here tonight. And then when it comes to the following the status quo, do you know what I mean by that? That just simply means, like, for instance, your 401k. What do you really know about retirement accounts? What do you really know about a 401k? Why did you start a 401k in the first place? Well, for a lot of people, it was following the status quo. You're young, you go to a job, you say to yourself, or you go to the job, you meet with the HR person, you're filling out your insurance and your benefits. And then they say, well, do you want this 401k? And you're like, well, what is it? They're like, well, it's really cool. You put your money in here before taxes. So you're getting a tax break right now. You're not getting taxed on the money. It's going to lower your taxable income for tax purposes. So you get it in there and it's going to grow tax deferred. And then so all the money you make over the years is going to grow tax deferred. And then later on in retirement, when you're in a lower tax bracket, you're going to pull the money out for retirement and it's all going to, you'll pay taxes on it then, but you'll be in a lower tax bracket then because of retirement. But think about that for just a second. Then you start asking them questions. You're like, all right, well, what if in 10 years from now, I want to buy a house or I want to buy a rental property or I want to use the money for something else? Okay, well, you can pull it out of your 401k, but we're going to penalize you 10%, plus you're going to pay taxes on it. So you're going to get penalized for using your own money, which is crazy. But then let me ask this question. What do taxes always seem to do? Are taxes not always going up? I mean, we're over $30 trillion in debt right now as a nation. We've printed almost $9 trillion in the last 2 years. We're spending money like there's no tomorrow. Interest rates have been at zero. The federal rate has been at zero for years and years and years. So the only way that we're ever going to pay for all of this stuff is through increased taxes in the future. So whatever those taxes are now that you're avoiding paying in that 401k, who knows how much more you're going to pay in the future for that. So things like that. Why do we do a 401k? Because that's what everybody else does, because that's the way it's always been done. Well, if they're matching that 401k, fine, let's put into the match maybe. But anything more, why are you giving up control of your money? Why are you putting off something that's inevitable that you're probably gonna have to pay more on later anyways? Why are you gonna be penalized for using that money? And if you need it during a downturn, for instance, with the volatility, then you're gonna lose all that money anyways. So why are we doing that? And a lot of the reason is fear, because we don't know any better, because we don't want to go against what other people have always done. Maybe you're just scared to do something different. Well, guess what? Fear is bullshit. Fear is overcome with education, support, guidance, hand-holding. And that's exactly what me and my team provide. All of that. So we're going to get that fear out of your life. I mean, I see a couple of people on here right now. Tess, I see John. I mean, I've been working with these guys for a couple of years now. I mean, I think when we started, they were probably kind of scared to jump into a lot of the stuff that we teach. But you talk to them now and they're telling other people about it. They're so excited. They're doing more and more of it. Why? Because they overcame that fear with our support, our education, and our help. And that's what it's all about. And then life is the last one on here, because life can get in the way. It's those unexpected things that can happen in life. Sometimes we can't avoid them. When it comes to life, there's just things that are unavoidable sometimes: an unexpected death, a divorce, a disaster, something like COVID that nobody expected, that shut down the country, that closed down so many small businesses, that made so many people lose their jobs. So life does happen, but guess what? We can overcome a lot of those things if we're prepared for them to happen. So there's an unexpected death. Well, let me have something in place where if that happens financially, it doesn't hurt me. Or I get divorced. Well, let me have something in place where that doesn't hurt me. Or if there's a disaster, something that doesn't hurt me, right? Or let's say there's a pandemic and I lose my job, or something happens and I lose my job, or whatever the case might be. Well, how about multiple streams of income, where if I lose one income source, I have other incomes that are keeping me above float until I can get my primary one back up and going again. So these little things we can do to prepare now for what we can't prepare to happen, or what we can't know will happen in life later on. So these are all just little things that are very, very important. And a lot of people consider this stuff excuses why they're not more successful. We're not going to call them excuses anymore, because we're going to overcome every single one of them. So these are the mysteries of money that we're going to throw out the window. We're going to kick their ass and we're going to move on. And a lot of that's up to you. A lot of that's up to mindset and doing a mindset shift. So there's a couple things that are important. I'm going to give you some homework here tonight as well. Okay. So number one, I want you guys to go on YouTube after this, and I want you to watch a video called The Backwards Bicycle. Go watch this video called The Backwards Bicycle. It's like an 8-minute video that this young guy did. And all he did was he took a bicycle and he reversed how the handlebars on it work. So typically when you ride a bicycle, you turn one way, the bike goes, you turn the other way, the bike goes the other way. So they reversed the way that works. But because we've rode bikes our entire life and we're programmed to think when I turn one way, it goes one way, when I turn the other, it goes the other way. When we reverse that, it's literally nearly impossible to ride that bicycle any longer. And this little video right here, that's about 8 minutes long, it talks all about that and why that happens, psychologically speaking, why our minds work that way. But it's a fascinating video and it's well worth the 8 minutes. So go check that out. The Backwards Bicycle. Here's a couple other good books that you can check out. These books all talk about the infinite banking concept, what I'm teaching here tonight. How about Robert Kiyosaki? Do you guys know Robert Kiyosaki? He was one of my mentors when I first got into alternative investments and real estate investing and passive income. The cash flow quadrant has been a big driver of what I've done with my life over the last 14 years. I've had the opportunity to train with Robert Kiyosaki and work with him directly. He's an unbelievable guy, but he talks all about the infinite banking concept in this book right here, The Second Chance. So check that one out. Tony Robbins, Money Master the Bank Game. He talks all about infinite banking in that book right there. Tony Robbins, another really, really unbelievable trainer and coach. Becoming your own banker. This is kind of like the Bible of the infinite banking concept. R. Nelson Nash is kind of like the godfather. So a lot of what we do, almost everything that we do, is based around this book right here. So highly suggest going to pick this one up. I would start with this if you're looking to get started with something. And then, of course, Mapping Out the Millionaire Mystery that Brent and Chris wrote together. It's kind of like an updated version of Becoming Your Own Banker. And we'll give you this book actually for free. All you have to do is pay shipping. So let me know if you want to get that, and I'll send you the link. And then the Private Money Guide that Chris wrote as well, another really, really powerful book on moving money and the importance of keeping money moving at all times. And so actually, what I can do is I will send you guys this Private Money Guide and Mapping Out the Millionaire Mystery. I'll send you digital copies of them for free if you want, just for being on here right now. So what I'm going to do for everybody that's on here right now is a bonus. If you go to this website, moneyschoolrei.com/Snagy, SNAGY, and just put in your name, email, and phone number, I will email you those books as well as a couple other resources completely free of charge just for being here right now. You will also on that link have an opportunity to schedule a free consultation with me, a call with me. So if you want to talk more about what I'm teaching you here today, about your situation, what might work for you, go ahead and get that call scheduled also, because my calendar does get booked out a couple weeks. So go ahead and complete that, get a call schedule with me. It's all free of charge. I'll get you over the books so you can start reading those before our call, and then we'll hop on and we'll chat about it. And by the way, this is my direct cell phone number, and this is my email. So if anybody ever needs to reach out to me with a quick question or anything like that, feel free. I'm here for you. This is all I do, 24 hours a day, 7 days a week, 365 days a year, unless I'm out of the country or on vacation with my family or something like that. But otherwise, I'm all money all the time for you guys. So again, my name is Stephen Nagy. I live down here in South Florida in the northern Palm Beach County area around Jupiter. So that's the Jupiter Lighthouse back there behind me. Right in front of me is the Jupiter Inlet and the Atlantic Ocean. My wife, Courtney, my son, Bryce, and of course, my smiling face right there. But like I said, I was a financial advisor with Ameriprise Financial out of college, was fully licensed, Series 766, 215 variable annuity insurance, and all that good fun stuff. Left it after a couple of years to enter the world of real estate investing, and have been in the alternative investment real estate investing space, coaching, training. I really love coaching and training. I love things like this, seminars, webinars, speaking on stages. And I've been doing that now for the last almost 14 years. So I've traveled all across the country, and I am licensed to do business in all 50 states as well. So just a little bit about myself. I'm an open book. If anybody wants to hear more about me or my situation or background, I'm happy to share that with you. But let's go ahead and get into the infinite banking concept here tonight. All right. So when it comes to money, we need to understand kind of how money works a little bit, how money flows. So let me just ask this basic question real fast, and just put a yes or no in the chat box. Can you make money earning 4% while paying 6%? Just put a yes or no in the chat box. Can you make money earning 4% while paying 6%? What do you think? So let me show you exactly what I'm talking about. I think you knew there was a trick question coming, right? All right, here we go. All right, so let me set it up this way for you. Let's say that you wanted to buy a car and you have $25,000 sitting at Wells Fargo in your savings account that you've been saving up in there to go buy a $25,000 car. So you go down to Wells Fargo, you go get with the teller, you say, hey, I want to withdraw $25,000 to go purchase a car. And the teller says, hang on, let me go get it. First off, we all know that they're not even going to give you that $25,000 right then. I had trouble not long ago getting $7,000 out of my bank. For some reason, they don't keep cash there anymore, right? But Nonetheless, anyways, so you go and you want your $25,000. So then some banker comes up, he's got his suit and tie on with his little badge that says vice president of whatever at the bank. And he says, listen, Steven, I know you want to go buy a new car for $25,000. So hear me out. Let's do this instead. Instead of you pulling your $25,000 out of your savings account, let's leave that $25,000 in there. And then what I'll do is I'll give you a loan for $25,000 to go buy that car. And what we'll do is we will use your savings account, that $25,000 in your savings account, as collateral for that loan. And you think to yourself, you're like, all right, I guess I could do that. So tell me more about the details. And the banker says, well, in your savings account, this is a magical savings account because we're going to pay you 4% in this savings account. Now, the reason I say it's magical is because no savings accounts are currently offering 4% in a savings account, but nonetheless, it's a magic savings account. So that's what this banker is going to do. And you say, well, that's fantastic. I would love to do that. I would love my money to sit there and grow at 4%. And you say, all right, well, what is the loan going to cost me? And the banker says, well, here's the best part. The loan, I'm going to charge you 6%. And you think to yourself and you say to that banker, you say, listen, banker, I know you think that I am not smart because when I walked in here, you have a bowl full of lollipops. And what is the name of those lollipops? What's on the name of every one of those lollipops sitting in that bowl at that bank? Dum-dums, right? All of the lollipops at every bank in the country are named dum-dums. So you say to the banker, I know you think I'm a dum-dum. You got the lollipop sitting right there, but there's no way I'm going to pay you 6% while you're paying me 4%. But here's the thing. Check this out. The banker then says to you, well, listen, I'm a banker for a reason because I do know a little bit about how money works. And if I don't, the bank taught me this, and banks definitely know how money works, and banks definitely know how to make money. So hear me out on this. So here's what happens. So you say, all right, well, prove it to me. And you can take a compound calculator and do the math yourself. But here's what happens. We take that $25,000 at 4% at the bank. So we say, all right, let's do it. Let me prove it. So then the banker says, all right, so the loan for $25,000 is at 6% for 5 years. That's a typical car loan, right? You guys okay with that? So our monthly payment's going to be $483. So you start making those payments back to the bank, just like any other car loan. Well, at the end of those 5 years, that $25,000, you're going to be paying the bank back a total of $29,000. So there's about $4,000 in interest there over that time span. However, over here, your money at $25,000 growing at 4% over the same 5 years, the same 60 months, that money just grew to be over $30,500. So if you would have listened to that banker, you would have just made over $1,500 by earning 4% and paying 6%. And the reason that happens is because the loan is a depreciating loan, right? So it's simple interest and it's depreciating each year, while over here, the money in the savings account was compounding every year. So when we compare simple versus compounding interest, it's a big difference, especially when it's a depreciating loan, simple interest, as opposed to compounding interest over here. So the reason that I show you this is a lot of what we do with the infinite banking concept is designed around this idea right here. And as we get into this, you're going to see exactly what I mean. But for right now, I just want you to understand you absolutely can make money at a lower rate while the money compounds, even though you're paying a higher rate in simple interest. So what is the money multiplier method? What's this all about? So number one, we have the machine. So the machine is the vehicle. The machine is the account that we're going to use for this. Number two is the marathon. I'll be very clear right now. This is not a get rich quick scheme. This is not a lottery ticket in the sense of you're going to get millions of dollars overnight or anything like that. This is a long-term play. You're going to have immediate benefits from it right away. Within 30 days, you're immediately going to start benefiting from it. But to make it to the third step of the money multiplier method, which is the millionaire, you are going to go through the marathon. The good news is it's not nearly as hard as a running marathon like I've done before that are just killer. This is kind of an easy marathon, so to say, is not doing anything. The beautiful thing about this marathon is what I'm teaching you. You're not working any harder. You're not working any longer. You're not taking on any more risk, but it's going to be a long-term play. So I just wanted to make that very, very clear from the start. But if you use this machine properly and you're in it for the long haul, this will 100% occur for you and your family. So what exactly is the machine? Let's talk about this. What is this thing that we use for this entire concept? Well, the machine is nothing more than a dividend paying whole life insurance policy from a mutually owned life insurance company. This is not a life insurance policy that your uncle or your brother-in-law or your friend from high school, or you call the person on the TV or the internet or whatever. It's not something that they can design for you. It's not something that is common that, everybody's out there doing. This is a specially designed and engineered whole life policy for the infinite banking concept, specially designed for you to become your own banker. So I want to make that very, very clear. This is what me and my team do every single day. We design and create these policies for you. So if what you're hearing right now, if this is something that you end up wanting to do for you and your family, you're not going to call some company. You're not going to call your agent now you've been working with. You're going to come to us and we're going to design this for you specifically for this concept. Okay. 99% of insurance agents have no idea how this truly works or how to set these things up properly. So I want to make that very, very clear. Also, this is not a IUL. This is not an index universal life policy. This is not a term policy. This is not any of that other stuff. We don't do any of that. We do 100% specially designed and engineered whole life policies for the infinite banking concept. That's it. If you want one of those other kind of policies, that's fine. Just go to somebody else for that. Okay. This is all we do. I just want to make that very, very clear. And I'll explain why we use these here in just a second. All right. But who else uses these kinds of policies for this concept? Well, first off, banks do. So a lot of the reasons we talk a lot about the banks is because banks know how to make money. Banks know financial rules and regulations in this country, and banks apply techniques that benefit them, period. So all we're going to do is do the same thing. So what I want you to do, homework assignment number 2, when we get off of here, is go Google BOLI, B-O-L-I. It stands for bank-owned life insurance. And what you will find is that banks are the number one purchasers of whole life insurance in the United States of America. I mentioned before, when you went and you talk to that banker about that car loan, they have a little badge on that says vice president, right? Everybody that works at the banks are vice presidents. Why is that? Because it allows the bank to then buy a whole life policy on that individual. They practice bank-owned life insurance, something called BOLI. So check that out later on, and we'll talk more about that. So who else uses this? Who else has used whole life policies and this strategy throughout history? Jim, and I want you guys, this can be homework 3. Write these names down and just go Google them later on. Jim Harbaugh. This was articles from 2016. In August, the University of Michigan announced it had amended its contract with head football coach Jim Harbaugh to include creative deferred compensation alternatives involving cash value life insurance. This type of deferred compensation alternative appeals to talented leaders and executives. Joe Biden. Joe Biden, in addition, holds 6 life insurance policies with Mass Mutual. Mass Mutual is one of the insurance companies that we do these policies with. Walt Disney started Disneyland in part, the financing, a large part of it came by collaterally borrowing money from his cash value life insurance. We might not even have Mickey Mouse right now if it wasn't for this strategy. The Pampered Chef, check out Doris Christopher. She started the Pampered Chef in a suburban home in 1980. In 2002, the company had grown into a $700 million operation, was acquired by Buffett for $1.5 billion. She used $3,000 borrowed from her life insurance policy to start the Pampered Chef. Ray Kroc of McDonald's. When cash flow was tight, He borrowed money from his 2 cash value life insurance policies to help cover salaries of key employees, as well as people like the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, and the list goes on and on and on. This strategy has been used for over 200 years. The tax code in this country has only been around for a little over 100 years, just to give you an example. So this has been around for a very, very long time. So what I'm teaching you here right now, it's nothing new. It might be new to you, but it's nothing new. It's been used for hundreds of years. These companies that we use, one of the reasons that we use whole life policies are because the insurance companies have been around for 120, 150 years. They're some of the most sound and financially secure companies in the United States of America. Where else would you want to warehouse your wealth? So we'll talk about that. But while I'm talking about the banks, let me show you a little bit more about how banks work. And before I do that, John said, but there is a risk losing all your funds if you attach to the market. Right, John? That's right. So John, that's why we use whole life policies. Our whole life policies are not tied to the markets at all. There is no relation. They're not indexed, nothing. That's why we don't use IULs. One of the many reasons we don't use IULs. Whole life is not tied to the markets. So John, that's why we do this. This is a risk-free place to store our money. As a financial advisor, as a broker, as an investor, you never use the word guaranteed. Well, I can tell you right now, your money's guaranteed in these vehicles. And that's one of the beautiful things about whole life. All right, so let me show you how banks work. This is real easy. This is just showing you how spread works. So when you take $100,000 to the bank, again, let's say it's a magic bank and they pay you 4% in your savings account. Well, the bank doesn't just take that $100,000 and let it sit there. They take that $100,000, they immediately put that money to work, right? So check this out. So you go get a home loan. Let's say they charge you 7% for a mortgage. Again, these percentages might be a little bit off, but at the end of the day, the spread is going to be the same. You take that money that they give you on that home loan, you give it to the seller takes it, they put it right back in the bank. The bank takes it, you go back to the bank, you say, I need a car note now. 8%, go to the car dealer. Now you need a home remodel, that consolidation loan. There's all kinds of different loans you could get at a bank, right? But the bottom line is the bank takes your money and they immediately start moving that money and they start making that spread. So what does that spread look like? Well, if you're getting 4 and they're getting 7, they're making a 3% spread. If they're getting 8 and you're getting 4, they get a 4% spread. And so on and so forth, right? So at the end of the day, they took your $100,000, they lent it out in all these different ways. You made 4% and they made 20%. Is that right? Yes or no? What do you think? Did the bank make 20% or how much did the bank make off your money? More probably, absolutely. How about this? A lot more, 500%. Because think about it. If you made 4%, 20% is 5 times more than the 4% you made, which is 500%. So the bank just made 500% off the money that you leave sitting there. And don't take my word for this again. Here's some more homework for you. One other thing you guys can look up. Go to BauerFinancial.com after this, BauerFinancial.com. BauerFinancial.com talks all about banks. They're a bank research company, corporation. So they go and they research banks and how banks operate and what kind of returns banks make and what they invest in and all this different kind of stuff. And Bauer Financial tells us banks make between 400 and 1,300% on money that you leave there. So let me ask this question. Why are you leaving all your money at the bank? Why are you leaving your money in a savings account? Why are you making the banks rich? Do banks make money? Do banks have a lot of money? Absolutely. Where are banks located? They're everywhere. They're the most beautiful buildings in the nicest cities in the world. They're on every street corner. They have branch offices everywhere. They're buying real estate everywhere. They buy whole life on all of those employees that they have. Banks know how to make money and they're making money off of your money. So stop it. Stop making them rich. How would you like to start recapturing that money into your financial life? How would you like your money to make 400 to 1,300% returns? Are you guys okay with that? Why haven't you started yet? Because nobody's taught you how to create your own bank. And that's exactly what I'm going to show you how to do right now. So let me show you how to start recapturing all of this money that you're giving to other people. So here's a great example of typical money flow in this country. So if we take $1 on average, 20 cents of every dollar that somebody spends goes towards automobiles. So for every dollar that you make, 20 cents of that dollar goes to a car, whether it's payments or upkeep or gas or whatever the case may be, okay? 30% or 30 cents of every dollar you make goes towards housing. 40 cents of every dollar you make goes towards everything else. So travel, kids, entertainment, food, on and on and on. So what's that leave us with? 10 cents. Only 10 cents of every dollar that we make goes to savings. So 90 cents of every dollar we make goes to everything else. 10 cents we keep. And that number is actually dropping right now in this country. So let me show you how to start recapturing that money. Let's do this backwards. Let's start with the savings. So first we should pay ourselves first anyways. You guys okay with that? Let's start making sure we have something for the future instead of everybody else. So let's do this backwards. Let's start with the savings. So let's give ourselves that 10 cents, but without doing anything different. Let me show you how to start increasing that savings. Again, remember, I'm going to show you, you're not working any harder. You're not working any longer. You're not taking on any more risk. We're just changing where our money goes first. So check this out. Instead of their bank, it's going to our bank. So of this 20 cents for every dollar that goes towards automobiles, on average, 5 cents of that 20 cents goes towards interest. So what we're going to do is we're going to take back that interest. So instead of giving that 5 cents of every 20 cents to Ally Bank or whatever bank gave you the car loan, we're going to put that into our bank. Okay. So that 5 cents is now going to our bank. Well, if it's my bank, that's my savings. That's my family's financial money for the future. So by doing that one thing right there, instead of giving the banks the interest, I'm giving me the interest for cars that we buy. Everybody buys cars anyways, right? I just increased my annual savings by 50%. Think about it. I was saving 10 cents before, now I'm saving 15 cents. That's a 50% increase in your annual savings with that one move right there. That's it. And I will show you specifically how we do this with buying cars here in just a second. How about housing? Did you know that on average, every 30 cents that's spent on housing, 25 cents of that 30 cents goes towards interest? Why is that? It's because banks are in control. Think about it. When you get a 30-year fixed mortgage, 90% of the interest paid on that 30-year fixed mortgage is paid in the first 7 years. So the first 7 years of that loan, 90% of the interest is going to be paid. Did you also know that on average, Americans either move and get a new mortgage or they refinance on average, you guessed it, every 7 years? So why do you think that banks always are doing teaser rates and pushing refinances, or, the markets tend to go up and down and people want to move and sell and get new mortgages? And there's things like due on sale clauses in mortgages. So somebody has to start over every single time. It's because they want their interest. They want that money and they want it now. So we can start taking back of all that interest we're giving to other people and putting that into our savings. And again, just where the money flows first. I'll show you this specifically in a second as well. And then on average, the 40 cents we're spending on everything else, on average, 5 cents of that goes towards interest. So let's go ahead and recapture that 5 cents as well. So by making this little change, by having our own bank, instead of giving all this money to other banks, we just increased our savings from 10 cents to, what is that, 5 cents, 30 cents, 35 plus the 10, 45 cents. So 45 cents of every dollar is now going to savings. This is what's happening for me. This is what's happening for everybody that's doing banking, as opposed to all that money going to other people. Are you guys okay with this so far? Everybody all right with this? So how to get all the money back for every car you'll ever buy, drive, and own. Let's go. So a whole life insurance policy, there's something called an illustration. And you're going to see a few different illustrations from this point forward right now. So this right here is what we call an illustration. It shows the policy year, the age of the individual that the policy is on. And then right here, we have what are called deposits. So these are also known as premiums. So the premiums are the amount of money that you're putting into this whole life insurance policy each year moving forward. Okay. Now, when you start one of these policies, you tell me how much in premiums you want to put into it on an annual basis. So I'm never going to tell you. Now, what I'll recommend is 10 times as a guideline minimum is 10 times your age on a monthly basis. So if you're 30 years old, $300 a month. If you're 50 years old, $500 a month. So that amount or more on a monthly basis is a good guideline minimum for your first policy. But you're going to tell me how much on an annual basis you want to put into this thing. And then you can pay into it monthly, quarterly, biannually, or all up front each year. That's completely up to you. But we're going to build it around that annual number. Now, why do we call these deposits? Because this is your new bank. I don't want you to look at this as a premium anymore. A premium is often thought of something that I have to pay. It's a negative. It's something that I dread doing. But if I had $10,000 check right now, and I needed to deposit it into my Wells Fargo bank account, well, I'm going to be excited to go do that, right? Oh, I'm going to put some money in my bank account. I'm going to increase my money in my bank account. So I'm excited. So starting from this point right now, you'll always hear me refer to these premiums as deposits. And this is one of those mindset shifts that I want you to start doing right now as well. So these are now deposits, okay? Now over here, this is what's called the money multiplier or the life insurance policy cash value. The cash value is the amount of money that's available for loans as the deposits go in. And then of course we have the death benefit over there. Now, a couple notes. Age doesn't matter. So this was a 26-year-old person. We do policies for 6-month-old babies. We do policies for people in their early 70s. If you're older than that, if you have some health complications that don't allow you to start a whole life insurance policy, something of that nature, don't worry. We have solutions for that also, okay? For instance, we can use somebody else's life where you can still own the policy. It's your bank. You use it for all the banking functions. It's just the death benefits on their life, that's all. So the age doesn't matter. And I did just now mention that the death benefit is on there. So the death benefit is the amount of money that is going to be paid to your beneficiary, whoever you want that to be, completely tax-free when you graduate, when you pass on. So let me show you how to start recapturing all of the money for every car you'll ever buy, drive, and own into the future, okay? So here we go, $10,000 going into this policy on an annual basis. In the third year, this guy wanted to buy a $25,000 car. So you can see the cash value increasing. They take a $25,000 loan out, decreases the cash value to that amount. And then if you were to take a loan from a traditional bank, you'd repay that loan, right? So if you take a loan from your bank, does it make sense to repay that loan? Are you okay with repaying the loan just like you would any other loan? Absolutely, right? So we're going to repay ourselves $6,000 a year to recapture that money. So we put $70,000 in, we recapture $30,000. We took $25,000 out. So we net injected $25,000 into this policy. Our cash value grew over that amount of time to $67,000. So if I put $75,000 in, I now have $67,000 in my account, and I have a $25,000 car sitting in my driveway. Well, I've now recaptured 91 cents of every dollar I spent to buy that car. I now have available again. Now we're not at 100% yet. And I'm going to show you how to do 100% because this thing keeps going. But I just wanted to show you, we've already recaptured 91% of every dollar we spent on that car. Plus this thing doesn't stop. Plus we have a $25,000 car sitting in our driveway free and clear. So if I go sell this car, even at $10,000, I'm now up over what I paid for that car in the first place, much, much, much more. And I drove it for 5 years. So just as an example, but again, this thing doesn't stop. Now, when I design a policy for you, the deposits are going to continue going in, okay? After the 10th year, that amount's going to drop. So the 10 would go in for 10 years and then it's going to drop, but the money would keep going in because why would you ever stop it? This thing becomes more and more efficient. Your cash value grows stronger and stronger and stronger every year that you own it. So you would never want those deposits to stop. But just to show you how this works in this example, we're going to stop the deposits on this policy. So we now have 67,000 sitting there. In the 8th year, the policy grew. We took a $25,000 loan out. So we now have 2 cars sitting in our driveway. We put no more deposits in. We recaptured $30,000. We took $25,000 out for a net injection of $5,000. But look what happened. Our money grew from $67,000 to $91,000, a $23,000 increase over those 5 years. We injected $5,000 into it, and it grew by over $23,000. We now have 2 vehicles sitting in our driveway free and clear, and we have $91,000 sitting in my account ready to go for the next use. So I would say I've recaptured all of our money. Are you guys okay with that? So there's 3 rules that we need to follow to make this work. Rule number 1, pay ourselves first. Rule number 2, pay ourselves back with interest. And rule number 3, always recycle and recapture our money. So just to reinforce that, and I'll show you as we get going how this works. Pay yourself first, pay yourself with interest, and always recycle and recapture that money. And if this works for a car, what else can it work with? What other major purchases do you have in your life? Boats, airplanes, remodel on your house, a swimming pool, on and on and on and on. This is all stuff that we can use this exact same concept for. All right. So that's one use of the money, recapturing that interest that we were giving to other banks, to other people. Now, let me show you how to pay off your debt quicker than otherwise possible while continuing to build your wealth. Because does anybody on here right now have any debts? Credit cards, student loans, third-party debts? Yeah, it's real easy for debt to start to add up. So this is a client of Brent's that was a chiropractor. He made good money, but he racked up a lot of debt in the meantime. So he had $478,000 in third-party debt. He was paying $5,777 a month. So if I add up all these monthly payments, he was paying $5,700 a month, almost $70,000 a year in third-party debt. So we did the math. It would have taken him 19 years to pay off all of this debt if he would have done it as planned. So we said, all right, let's help you out here. So what we did is we started a policy for this chiropractor where he's putting in $25,000 a year. Okay. So the first year of this policy, he puts in $25,000. The cash value of that $25,000 available to him right away is almost $15,000. Now, let me be clear. The policies that we designed today, this was about 10 years ago that this one was done. The policies we're designing today, your cash value that you have available immediately, especially if you want real high cash value quick, we can get it much higher. Okay. We can even push 90% or more if we need to. So we can get you access a lot more if you need, but always love to under promise and over deliver. Watch how awesome this works using this right here as an example. So 25,000 goes in the first year. We take a loan from the policy of $15,000 and we take that $15,000. We immediately pay off the Discover card. We pay off the Lowe's card and we pay down the Nordstrom balance. Okay. So what did we just do? We just eliminated these payments to Discover and Lowe's. However, remember the rule, number 3, we always want to recycle and recapture that money back to us. So what we're going to do is we're going to continue to make those monthly payments, but instead of making those monthly payments to Discover and Lowe's, who are we going to make those payments to? Our bank, right? The Bank of Stephen. So now I'm going to make those, if you do the math right here, it's $448. So now each month I'm going to pay myself $448. And now I have $5,329 going to third-party debtors. Now, where does this $448 a month go? It goes into what we call a segregated bank account. So one of the things we're going to teach you how to do is set up a separate checking account just to be used for this concept. And that checking account is going to be where the money loans go to. So when you take a loan from the policy, this cash value loan, it goes to that segregated checking account. From there, it goes to pay off the debts. And then as we recapture the money, it goes back into that segregated bank account. So then we can use it year after year after year, which I'll show you in just a second. So we're going to start recapturing that money back to us. So year 2 of this policy, $25,000 goes in. Now we have $16,000 available in the policy of cash value after that 25 goes in. And then we have $5,000 in recaptured payments. The $448 a month is $5,374 a year. We now have that available to use as well. So now we have $22,000. What are we going to do with that? We're going to pay down the Nordstrom, or pay off the Nordstrom, pay off the Wells Fargo credit card, pay off the private loan, and reduce the balance on the BMW. Same thing. We're now going to pay ourselves these monthly payments, and we're going to reduce what we're giving to third-party debtors. Third year, 25 goes in, 25 available, 23,000 in those recaptured payments, 48,000, pay off the BMW, pay off the West Marine, and pay down the condo. Same thing. We now have 3,600 back to us, 2,100 to third-party debtors. All right, let me make sure you guys are following so far. Here's a quick little test. In the first 3 years, we put $75,000 into this policy, into your bank. We took loans out the first 3 years, totaling $55,000. So if we put 75 in and took 55 out, how much is left within your policy? How much do you have still in your bank account? I want to make sure you guys are following me. Put it in the chat box. How much do you have left in your policy? If I put in 75 and took out 55, a lot of people think 20,000, right? It makes sense. But what's this magic word right here? Loans. Check this out. We still have the full $75,000 in our policy, in our bank, doing what? Compounding and growing uninterrupted every year for the rest of your life. Now, how does this happen? It's because when we take these loans from our policy, it's a loan from the insurance company's general account. And our policy, our money that's in there is being used as collateral for those loans. Just like I told you with that example at the very beginning, this is the exact same thing. We're using our policy as collateral. So that allows the whole amount to stay in there compounding and growing, even when we're pulling all that money out of there to use it for something different. All right. So just wanted to make sure you're following. Fourth year, 25 goes in, same thing. Fifth year, 25 goes in, same thing. So after 5 years, we've eliminated everything except for the house. Now in the 6th year of this policy, something different happens, okay? Now in the 6th year of this policy, instead of $25,000, they were only able to put $10,000 in. Now, like I said, on your policy, this is gonna happen in the 11th year. So if you want to do $25,000 for the first 10 years, in the 11th year, it's going to drop down to about 10,000, or we can eliminate it, or there's lots of different options. Talk to me on the call. But in this situation right here, the 6th year of this policy, that amount dropped down to 10,000. Of that 10,000 they put in on that first policy, they had 13,000 available for a loan. Now, what they wanted to do though, because they loved how this was working and they loved putting money into their bank instead of other people's banks, this chiropractor said, well, I want to put more money in. I don't want to just put 10 in. I want to put more money in. Well, because of different rules and regulations, you can't put more money into an existing policy over and above what it was designed for. But you can have as many policies on yourself as you can qualify for. So you can start stacking these policies to build your banking system. So this chiropractor in the 6th year started a second policy. So his first one, 10,000 is going in. His second one, he wanted 25,000 to go into that one. So he's now putting 35,000 a year into his banking system. Of that 25 on the second policy, 15,000 was available. We have the recaptured payments. We have total cash that we're able to use to pay off that house. So in 6 years, we were now able to eliminate all third-party debt. Now, he has no money he's paying anybody else. What is he doing with this $5,700 a month? Yep. He's going to continue to pay that back to his segregated separate checking account, his segregated bank account. And then from there, as it builds in there, now we're going to start cycling it back into the insurance policy. And now it's going to be ready to be borrowed back out again over and over and over again. Because if you have no third-party debt, well, maybe you need to buy a car. Or if you have no third-party debt and you don't have any major purchases to do, well, what do you do with it then? And that's where the fun starts. Hang with me for 2 seconds. I'm going to show you how that works. But before we get there, let me just to say to you, if you liked how we set up that plan and created that map for the chiropractor to pay off all that debt, we will do the exact same thing for you. Okay. So every one of our clients, free of charge, we give you what we call our mapping services. So we're going to do a cash flow analysis with you. We're going to look at all the debts. We're going to talk to you about it. And we're going to create a roadmap, a debt map, an action plan on how immediately within 30 days of starting your policy, within 30 days, you have this debt map started, you have your loans out of the policy, and you're already starting to tackle that debt. So we're going to create this for you. I like to call it a financial GPS. So we're going to do all of this for you free of charge. And John said, what's your fee to run the policy? There's no fee. We don't charge anything ever. We do all of this free of charge for you for being a client. We get paid a direct commission from the insurance company for bringing them the business, just like any other insurance agent, car agent, health agent, homeowners insurance agent, anybody out there, we get paid the same way, a direct commission from the insurance company. And that allows us to provide ongoing support, mapping, hand holding. I'm available to you anytime, completely free of charge. You'll never pay us a dime for any of that. You guys okay with that? Everybody all right with that so far? All right. Let's talk about fun for just a few minutes before we wrap things up here. So what if you don't have any bad debt? What if you don't need to make any major purchases? Can you still benefit from privatized banking? Should you still become your own banker? And the answer is, oh, hell yes, because this is where the fun begins. This is where you can start building wealth and creating a legacy. So when I opened up earlier, I mentioned that on our other webinars, we start talking about creating wealth. And this is what we teach in Money School. This is what we teach in our 3-day trainings. This is what we teach on our wealth webinar. So for instance, in Buffalo in a week and a half from now, we will be teaching you all of these different strategies for creating wealth. The reason we teach multiple strategies is because different strategies work in different markets, depending on a market downturn, market upturn, in a booming market, in a bear market, in a bull market. What's going on in the country, what's going on in the world. These are all different strategies. Some people want to do active investing. Some people want to do passive investing. Some people want to own a business. Some people want to do stocks and options, notes, crypto. There's so many different ways to create wealth. All we're doing with this bank, with this policy, is where your wealth is warehoused. So instead of, let's say I want to do a private money, or let's say I want to buy a rental property, right? Well, if I'm going to buy that rental property, I'm either going to go to my bank account and pull the money out, or I'm going to leverage it, or I'm going to pull the money from my bank and leverage it, right? So it doesn't matter where the money is. We're going to do the exact same thing. It's just this bank is giving me all the advantages of uninterrupted compounding interest, while Wells Fargo is paying me 0.01% in my savings account right now. That's the only difference. There's no other difference. So let me show you specifically what I'm talking about with this. All right, so there's 2 laws for creating growing wealth. Number 1, I've been talking about it all night, compounding interest. Einstein said it best. Einstein said it's the 8th wonder of the world. Those who understand it use it. Those who don't pay it. Number 2, keeping money moving. Money sitting still is losing money to inflation. Money in motion is making more money. So we need to get that money moving. We need to get that flow of money happening right away. So right here, the policy is giving you the uninterrupted compounding interest, and the strategies are going to keep that money moving and making more money for you. So let me show you how that works. This is an example of an illustration. So this is an illustration I did for a 41-year-old lady, just, I don't know, earlier this year. So in this policy, that premium, those deposits, she wanted to put in $150,000 the first year, and then $50,000 a year after that. And then you'll notice, look at that, what I say earlier. In the 11th year, that amount drops down. Look at this. We can also do the first year, we can do what we call a dump in. So if you have some equity in your house, you did a refi, or you have a HELOC, or you cashed out of some stocks at the highs, or you cashed out of some crypto, or you have some money sitting right now and you're scared to invest it because you don't want to lose it. Again, maybe it's sitting in a savings account at the bank, earning you basically nothing. We have the ability to dump in a larger amount the first year on this policy and then something more manageable moving forward. So they dumped in an entire extra $100,000. Now look at this. The cash value, what I say earlier, the cash value is what we have available for loans, right? So they dump 150,000 in, they have over 130,000 they can pull right back out to put the money to work. The second year they put 50,000 in, they have 48,000 of that available. The third year they put 50,000 in, the increase in net cash value just becomes stronger and stronger and stronger every year for the rest of her life. Look at this. When she's 55 years old, she puts $17,000 into the policy. It grows by $54,000. Show me any other bank in the world where I can go make a deposit right now of $17,000 and they immediately let me take back out $54,000. It doesn't exist. Risk-free. It does not exist. Here's another example of a policy. So this one was $50,000 dump in, but they only wanted to do $6,000 a year, but they wanted to pay monthly. So they dumped in $50,000 and immediately started putting $491 a month in. You can pay monthly, quarterly, annually, biannually. The first year they had $51,500 available. Dumped in $50,000 and started doing $500 a month. And just look at these returns on this thing as it grows and compounds. Such a beautiful thing. So here's the flow of money. So here's your money multiplier insurance policy. You take a loan. Now, when you take a loan from a policy, the insurance company is going to charge you anywhere from 3 to 5%, depending on how that loan is taken and what the company is. The money's going into that segregated account that I told you about. And then you're going to take that money and you're going to do something with it. In this case, we did a private money loan to somebody in the private money club. So the private money club is just a platform that I invest in. There's a bunch of deals in there and borrowers where you can lend your money to, first lien position. And then they're going to start paying you monthly interest payments. So I make 12% on our money. I pay the loan 4%. And what do I keep? I keep that spread. Just like we were talking about earlier, the bank keeps the spread. I keep the spread. So the insurance company gets 4%. I get 8%. And my money sits in here compounding and growing uninterrupted for my rest of my life simultaneously while the rest of this is going on. So this quick example of how the money flows. So here's an example of using that same policy to do a private money loan. So check this out. In the 8th year of this policy, the policy grows by $66,000. To get that return, I have to inject $48,000 into the policy. So my policy grew by $18,000 that year when I put $48,000 into it. That's a 37% cash on cash return on our money. Remember, our money has to go somewhere, right? So is it going to someone else's bank or is it going to your bank? So then we take that money and we do a private money loan. So a private money loan, again, the money's got to come from somewhere. So am I taking it out of my savings account or am I taking it out of my private banking account? So that private money loan pays me 12%. My money grew my policy at 37% that year. I paid 5% to the insurance company for that loan. So I just made 44% return on my money. We did nothing different except where the money goes first. So you tell me right now, would you rather make 12% doing a private money loan, or would you rather make 44% doing that exact same private money loan? Remember, we're not working any harder. We're not working any longer. We're not taking on any more risk, just where your money goes first. And by the way, we didn't even talk about the death benefits tax-free and creates a legacy for your loved ones. The loans never have to be repaid. So when you take loans from this thing, how, when, or even if you ever repay those loans, it's completely up to you. The values, the growth that I've been showing you, that cash value growth of this thing, completely tax-free. Policies are exempt in most states from judgments and liens. Oh, and by the way, we can use these for businesses. Go check out something called COLI, company-owned life insurance. When you schedule a call with me, ask me using this for a business, if it's better to do loans to your business or have a company-owned policy. We can talk about the pros and cons. But what I do is I take a loan from my personal policy. I lend the money to my company. My company uses the money for company business. My company pays me interest on that. My company gets a tax deduction. And then the money cycles right back to me anyways. So we can talk about that. Oh, and kids policies are unbelievable. What you can do with kids policies. I started one for my son Bryce last year when he was 5 years old. And that thing's ridiculous when he gets to college age and beyond what that thing looks like. So we can start planning for our kids' financial futures, but more important, we can start teaching our kids smart financial education. And this is a beautiful thing when it comes to kids policies. So something else to start thinking about and implementing into your financial life. So with that being said, again, this stuff right here, these are just excuses. There's no reason for any of them. We solve this right now, tax-free growth. Inflation, our money's now going to start keeping up and beating inflation. We're getting rid of volatility. This is guaranteed. We're going to stop doing what everybody else is doing. We're going to start preparing for life. We're going to start doing what the wealthy do, start doing what the banks do. It's time. Buffett said it best: if poor people would just do what rich people do, they wouldn't be poor anymore. So I want you to ask yourselves these last two things. Are we better off with or without one of these policies, with or without our own private bank while we're alive today? And are we better off with or without this thing when we pass away and we die? And I know the answer to me is an outstanding yes on both of these questions. So if you're ready to take back control of your financial situation, take advantage of uninterrupted compounding interest, and implement a strategy that's been used by some of the wealthiest people in the world over the last couple hundred years, this is how you can schedule a call with me. You're going to want to go on this website right here. Like I said before, my calendar's on there. I'll also send you free copies of the books and some other bonuses. Or if you prefer, send me a text message or an email, and we can arrange the call that way. So this is my cell phone right here. You can send me a text message. Here's my phone right here. Send me a text message and we can get the call scheduled, or go right on there and schedule it with my calendar. Or if you need to schedule something like outside of business hours in the early morning or late at night or something like that, I have no problem doing that either. So just shoot me a text or an email and we can work that out. All right, guys. So that's all I have for you on the infinite banking concept. I saw one question coming in. So what's the annual return? John, so the annual return that your money makes is up to you. How you're using that money within the policy, what kind of investments you're making, what you're doing with that money. Internally, the policy is going to grow through dividend payments that the insurance company pays out, which right now are anywhere between 5.2 to 6%, depending on the insurance company. So that's the internal tax-free growth. But otherwise, it depends on you and how you're using the money. And there's no fees or anything like that for the policies. But the loan amount coming out, again, is 4 to 5% simple interest. And then your money is in the policy compounding at about 5%. So hopefully that answers your question. And yeah, you can borrow the money to buy apartment complexes, to buy any kind of real estate. Yeah, we teach that stuff all the time, John. So I love the way you're thinking about using those policies. Get the money in there, immediately pull the money out and put that money into investments that are growing for you, appreciation, paying, rents to you on a monthly basis, paying interest to you on a monthly basis. And I will put my my numbers on the screen, Jermaine, but I'll put in the chat box right now also. All right, cool, guys. Does anybody have any last questions? Otherwise, I look forward to talking with you. Like I said, get a call scheduled or shoot me a message and we'll get that call scheduled. I hope everybody has a great week. Join us tomorrow for Wealth Webinar, 9:30 a.m. What the F happened, 1 p.m. Eastern. Wealth Webinar Wednesdays. Chris and I have something really cool designed for you tomorrow. And then we do Ask Me Anything every 4:30 Eastern every Wednesday also. So we'll see you guys there. Otherwise, hope to see you in Buffalo at the end of the month at the live event in person. Hope you guys have a great day. We'll talk to you soon. Thanks so much.